We are living through a historical moment that is difficult to identify as it happens. Almost always great economic changes are only well understood once they have passed. But this time is different. This time we have an uncomfortable advantage because we know the system is changing, even if we are not yet clear on what it will become. In recent months, an idea has become very popular, repeating over and over on social networks, in podcasts, and in economic videos. It is the belief that there is a very short window of time to create wealth before artificial intelligence completely transforms the labor market and the economic system. Some speak of 5 years, others speak of a decade, but the message is always the same. Do it now, or it will be too late. Today, we want to analyze this idea with much more calm. No headlines, no drama. And without selling a narrative of artificial urgency. Because on this channel, we consider that the real problem is not whether you have 5 years to get rich. The real problem is that the economic model upon which most people organize their lives is entering a phase of structural transformation. And that transformation is not evident at first glance. The message we want to convey is not that work is going to disappear. The message is that work is losing power. And it is not the same. This narrative is born in large part from articles and debates driven by influential economic media such as the Wall Street Journal, and above all from conversations repeated within the most advanced technological environments in the United States. But here we find a fundamental nuance that almost no one mentions. We are not talking about an official economic policy report. We are not talking about a scenario agreed upon by international organizations. We are talking about the strategic vision of those who are building the technological infrastructure that will define the next stage of the productive system. That is to say, they are not neutral observers. They are direct actors of the change. And when the builders of a new technology warn us that the value of human labor is going to fall, they do not do it from economic theory. They do it from the design logic of the new system. That completely changes how we should interpret this message. Now then, beyond headlines and opinions, a data point does exist that deserves real attention. The International Monetary Fund has warned that approximately 40% of global employment will be affected by artificial intelligence. We want to stop for a moment on a key word. Affected. It does not mean eliminated. It does not mean destroyed. It does not mean replaced automatically. In labor economics, the term affected implies 3 possible things. First, that part of the tasks are automated. Second, that the content of the work changes. And third, that certain specific positions no longer make economic sense. We consider that the great error of many current analyses is treating this process as if it were binary, as if the economy worked on an on and off switch. Either you work or you do not work. The reality is quite a bit more uncomfortable. What is starting to erode is not employment itself. What is starting to erode is the price of labor. That is to say, how much economic value an hour of human work generates compared to an hour of technological capital. And this difference is absolutely crucial. Because throughout history, when the relative value of labor falls against capital, the distribution of wealth changes. Not because of ideology, but because of productive structure. To understand why this revolution is different, it helps us to compare with the previous ones. The Industrial Revolution multiplied physical strength. One person with a machine could produce what previously required dozens. The Digital Revolution multiplied the capacity for management, communication, and coordination. But artificial intelligence is multiplying something much more sensitive, which is productive cognitive capacity. We are not talking about a faster calculator. We are talking about systems capable of generating text code design, analysis, planning, simulation, and operational decision-making. This is not just a tool. It is a new type of productive factor. And here a profound change appears that alters the classic logic of employment. In previous revolutions, although certain tasks were automated, economic growth generated large volumes of complementary employment. New industries, new sectors, new professions. In this transition, we are living through a relevant part of the value chain can be covered by non-human systems. Not an isolated task, but complete processes. A good example of this change is found in companies like Anthropic. Beyond the specific product, what is relevant is the conceptual leap. Systems that can write functional code, correct errors, structure complete projects, generate technical documentation, execute tests, and improve versions. They do not function as passive assistants, but as productive agents. This does not mean that all programmers are going to disappear. It means something more subtle and deeper. that the relationship between production and the number of workers is beginning to break. A company can generate more products, more services, and more value with increasingly smaller teams. And when this happens systematically in an economy, the pressure is not exerted on employment, but on wages, labor stability, and the bargaining power of the worker. This is the point that almost no one wants to look at head-on. Artificial intelligence does not need to destroy millions of jobs at once to change the system. It is enough for it to make each worker economically less essential. And that reduces their power. There is a very widespread idea that the safest jobs are office jobs, intellectual jobs, and skilled jobs. For decades, the message has been sold that studying more was the great protection against automation. But today, the frontier is no longer the educational level. The frontier is the type of tasks that are repeatable, tasks that follow clear rules, tasks that operate on digital information, tasks that can be evaluated by objective results. They are precisely the easiest to automate. Accounting, administrative management, customer service, basic analysis, standard writing, content editing, or routine programming. Not because they are unimportant, but because they are structural. And once something can be structured, it can be modeled. Here, a paradox appears that is becoming very visible. The more digital a job is, the more exposed it is to automation by digital systems. For years, we were told that digital was the secure future, but today digital is the first battlefront. This change does not affect all workers equally, as it affects them very unequally. And here we enter one of the most important concepts for understanding what is coming, which is the so-called K-shaped economy. In a traditional growth economy, the population as a whole benefits with more or less inequality from the same cycle. In a K-shaped economy, one part of the population sees its economic position improve at an accelerated pace, while another part enters a trajectory of stagnation or deterioration. They are two trajectories that separate. And this divergence is not produced by individual effort. It is produced by structural position within the productive system. The line that separates those two trajectories is not talent, nor intelligence, nor work ethic. It is the relationship that each person has with productive assets. And this is where our analysis begins to get uncomfortable. Because the majority of the population depends almost exclusively on selling their time, while a growing minority participates in the ownership of productive systems, such as companies, infrastructure platforms, networks, technology, or financial capital. When productivity accelerates thanks to technology, the value generated is channeled toward those who own those systems, and not toward those who operate them. This is the silent change. We are not facing a fight between humans and machines. We are facing a reconfiguration of the distribution of the economic surplus. And this reconfiguration is not new. What is new is the speed and depth of the change. From here, a key question arises that is almost never formulated correctly. We wonder if there will be work in the future. Very probably yes. But the relevant question is another. We question whether it will be enough to depend solely on work to build economic security. That is the real issue. The discourse that you have 5 years to get rich oversimplifies a process that is much more complex. There is no clock marking the end of opportunities. What exists is a transition phase, a phase in which the productive systems are not yet completely reorganized, in which frictions exist, in which companies are still learning to integrate artificial intelligence into their processes, in which markets have not yet fully adjusted the valuations of asset sectors and business models. And it is precisely in these transition phases where the large shifts in wealth occur. Not when everything is already clear, but when it is not yet. What we are seeing is not the end of work. It is the end of a type of security based exclusively on a salary. For decades, the implicit contract of the system was simple: training, employment, salary, stability, and savings. That contract was already weakened before artificial intelligence. Technology simply accelerates its rupture. Therefore, when it is said that this may be the last great opportunity to create wealth, the message must be translated correctly. It does not mean that within 10 years wealth cannot be created. It means that the mechanism of economic advancement based almost exclusively on skilled work is losing strength. And that profoundly changes personal strategy. The true transition we are living through is not technological. It is a transition in the way in which economic value is generated, captured, and distributed. Technology is the catalyst, but the change is structural. And understanding this is the basis for not falling into two very common errors. The first is paralyzing alarmism. The second is the false tranquility of thinking that everything will continue working as before. Neither of the two positions is useful. The only truly useful thing is to understand what role each one is going to play within the new productive system that is already forming. And that is the question we should really start asking ourselves. We continue this analysis by exploring one of the deepest and least discussed consequences of this transition, which is the deflation of intelligence. We want you to understand that historically specialized knowledge and analytical capacity were scarce resources and therefore very valuable in the market. Studying a technical career or a specialization was the surest way to guarantee high income because the professional sold something that few had. However, artificial intelligence is turning the capacity to process information into an abundant and extremely cheap raw material. When a resource becomes abundant, its market price tends inevitably downward. If structured knowledge can now be obtained in seconds at a marginal cost close to zero, the salary of those who base their value exclusively on that knowledge suffers deflationary pressure. This forces us to rethink the value of our own professional training and that of future generations. It is no longer enough to know how to do something that a language model can learn in an afternoon. We consider that the new economic value now resides in the capacity to orchestrate these tools to generate complex and unique results. It is the critical step from being a simple executor of tasks to becoming a process architect. This distinction is what will mark the dividing line between those who are displaced by the system and those who use it as a multiplier of their own wealth. Additionally, we must observe the impact of this change on the traditional savings system and on retirements. Most retirement and old age savings plans were designed under the premise of a stable industrial or service economy, where growth was predictable and inflation was controlled by classic monetary mechanisms. But in a K-shaped economy where value is concentrated in the owners of technological infrastructure, passive savings, and traditional currency run the risk of losing the race against asset inflation. We want to emphasize that financial security in the next decade will not depend on how much money we manage to keep under the mattress or in conventional bank accounts, but on how much participation we have in the assets that are actually capturing the growth in productivity. We are talking about a transition from the labor economy to the capital economy. If the engine of wealth creation is no longer human effort but computation and energy, we must ask ourselves if our investment portfolios reflect that new reality. In this sense, we observe that energy is becoming the new gold standard of the 21st century. Without massive and cheap electricity, there is no computing capacity, and without computing capacity, there is no artificial intelligence. Therefore, the nations and companies that control the energy infrastructure and data centers are the new pillars of global economic stability. This leads us to analyze technological sovereignty as a factor of personal protection. It is no longer just about geopolitics between great powers like the United States and China. It is about how each individual and each family manages to position themselves against this new structure of power. A real risk exists that the wealth gap will become a gap in access to productive technology. That is why when we speak of a window of opportunity of 5 or 10 years, we refer to the time it will take for markets to correctly value these assets. Once the system has been completely reorganized and all companies have integrated artificial intelligence into their DNA, profit margins will stabilize, and explosive growth opportunities will be much harder to find. We are in the period of friction, where inefficiency still exists, and therefore where it is still possible to capture extraordinary value. We want our audience to understand that the alarmism we see in the media usually hides the true strategic opportunity. We should not be afraid of machines doing our work, but afraid of not owning a small part of those machines. Economic history teaches us that those who prosper in transitions are not necessarily the brightest or the hardest working, but those who manage to identify where the economic surplus is shifting before the rest of the world does. At this moment, the surplus is shifting from salary payrolls toward technological dividends and infrastructure rents. This structural change has ethical and social implications that we cannot ignore, but from a purely economic point of view, the strategy is clear. We must stop seeing ourselves solely as workers who offer their time, and start seeing ourselves as capital managers who seek to participate in the production systems of the future. This implies constant financial education and vigilance over how large corporations are redrawing the map of global influence. The concentration of power in a few hands is a challenge for democracy, but it is also a clear signal for the investor and for the citizen who seeks to protect their assets. In the coming years, we will see how entire sectors that we consider solid today crumble, while new forms of value arise that today we can barely imagine. The key to navigating this sea of uncertainty is not paralysis by analysis, but a deep understanding of the forces that move the strings of the world economy. We are at the end of a social contract that lasted almost a century, and the birth of a new one that does not yet have written rules. Participating in the creation of those rules and in the ownership of those new systems is the only real way to guarantee our economic freedom in the times to come. For all this, we insist that the window of opportunity is not just for getting rich in terms of luxury, but for ensuring personal sovereignty before a world that is leaving behind the logic of salary as the basis of society. We want to add a fundamental point that is often ignored in purely technological debates. It is about the human factor and accumulated experience. Despite the fact that algorithms can process data at an amazing speed, they lack something that our audience possesses in abundance, which is judgment. Judgment is the ability to distinguish the important from the urgent and the real from the artificial. In this new economic scenario, wisdom and long-term vision become extremely valuable assets. While machines optimize processes, we humans must optimize purposes. It is not just about accumulating capital for the sake of having it, but about using technological tools to free up our time and dedicate it to what really adds value to our lives and our families. True wealth in the age of artificial intelligence will not only be financial but also a wealth of autonomy and freedom of choice. That is why we encourage you not to see this technology as a distant enemy, but as an ally that, well managed, can work for us while we focus on living with purpose. This is the essence of the transition we defend in this space. A transition toward a model where the human being is at the center again, thanks to the fact that routine tasks are finally assumed by technique. This is the true paradigm shift that we must embrace so as not to be left behind in history. If this analysis has been useful to you and you want to continue deepening your knowledge of the topics that really move the strings of the global economy, we invite you to subscribe to our channel and become part of this community of continuous learning. We are also very interested in knowing your vision, so we ask you to leave us your reflections in the comments about how you are perceiving this change in your close environment. In this space, our mission is to continue providing clarity and tools so that we can all navigate this transition with security and knowledge. We thank you deeply for joining us today, and we remind you that the best investment will always be our own education. We say goodbye for now, but we will meet again very soon to continue analyzing together the economy and the world around us. Thank you very much for your attention, and until next time.